First of all, I'd love to start with a quick acknowledgement of country. So in the spirit of reconciliation, Bloom Impact Investing acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respect to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islanders peoples today. So welcome everyone. My name is Camille. I am the director and founder of Bloom Impact Investing. So what is Bloom? So Bloom is on a mission to allow people to learn more about impact investing and to empower investors to access sustainable returns while making a difference. We are particularly passionate about climate change here at Bloom. And we want to see a world where a carbon-free economy allows people and the planet to thrive. We work hard to make investing in climate solutions easy and financially rewarding. And part of this mission is to propel the voices of experts in this field as far and wide as possible, so that people like you and I can do well while making a difference. But enough about us. Today, we are privileged to have Amy Reid with us. Amy is a financial advisor at FIRSTUNITY Wealth Management. So before we jump in, please let me introduce you to Amy. So Amy provides holistic advice and is skilled in the areas of budgeting, investments, risk management, insurance, superannuation, retirement planning, estate planning, and my favorite, taxation. Amy has a double degree in psychology and business administration from Macquarie University. She has a diploma of financial planning, an advanced diploma of financial planning, and is also a member of the Financial Planning Association. And finally, she has completed the Certified Financial Planner certification. In other words, she is a pro. She now works at FIRSTUNITY Wealth Management, which is a boutique financial advisory firm providing bespoke wealth management services to affluent individuals, families, and not-for-profit organizations. So without further ado, I will let Amy jump in her presentation. Thank you.
Hi guys, thanks for joining us and thank you for that introduction, Camille. Yeah, I guess I'll just jump straight in. We're going to have a bit of a talk about investing with impact during COVID-19 crisis. Just a bit of the boring stuff. This will all just be general in nature and doesn't constitute personal financial advice. So don't take it as your, you have to invest in this, because it doesn't take in your personal objectives and needs and financial situation at all. So we're going to have a look a bit about, just have an update of the market in general and a bit of an outlook of what, my view of it is to come. Impact investing and the role that plays, and then some investment strategies, all with the overlay of obviously COVID-19 and how that is impacting all of these things. So we have just witnessed, we are in the middle of the greatest pandemic since the Spanish flu of 1918, the greatest oil price decline ever, which we just saw in March, the greatest economic contraction since the Great Depression, and the greatest central bank and government intervention of all time. So it's been rough. The share, bond and commodity markets related statistics from the end of March were remarkable. The average daily change in stock markets in March was 4.8%, making it the most volatile month in markets ever. At the end of March, Deutsche Bank's index of early US economic indicators had essentially gone into free fall, indicating data which is about 12 standard deviations worse than average. Now, I don't know if you know much about statistics, but I think we all know enough about stats to know that there aren't really supposed to be 12 standard deviations. 3 is usually plenty. And then recovery. A month-long rally, which we just saw in April and May, that saw most indices climb back from their March lows. In just a few short weeks, the COVID-19 narrative has shifted from how bad things will get to how soon we can recover. Yet the economic data is still horrendous, with the potential for worse to come if the US is hit by a second or third wave. Fears are growing that the global economic downturn that we are currently experiencing could be far more punishing and long-lasting than initially feared, as governments intensify restrictions on business to halt the spread of the pandemic, and the virus reconfigures the very concept of public space, slowing consumer-led economic growth. The pandemic is above all a public health emergency. So long as human interactions remains dangerous, business cannot responsibly return to normal. And what was normal may not be normal anymore. People may be less inclined to jam into crowded restaurants and concert halls even after the virus is contained. The abrupt halt of commercial activity threatens to impose economic pain so profound and enduring in every region of the world at once that recovery could take years. When this is the news we hear daily and announcements of historically bad unemployment numbers are being shouted from every news channel, not just locally but globally, you would think, you would expect share markets to show some kind of negative reaction. This has not been the case. We've seen, this is the recovery I'm talking about, the S&P 500, which is the US main kind of index, is showing that they basically haven't lost any ground for a year. So yes, they went up to big highs in mid to late February and then dropped, 30–40%, but they've come back so that a year ago, it's about the same, which is just incredible considering the economic data is so dire at the moment. And the S&P ASX 200, which is our Aussie top 200 shares, have pretty much followed suit. I mean, they're still a little bit behind a year ago, but the pattern is very similar, as you can see from those two slides. The obvious reasons markets have recovered from the March plunge is the unprecedented government and central bank intervention since the coronavirus crisis started. Put simply, central banks have been supporting financial assets and governments have been supporting the real economy. Without this intervention, the economic data does not look good. There is a general consensus that the worst is yet to come, and equity markets may be set to experience another large fall. From here, I'm going to go into impact investing. So, I mean, I guess we've just covered off that we're thinking, that there probably will be some more pain to be felt within the markets. But let's look into, do a few definitions about impact investing, and then we'll kind of pattern that out as to what we think this economic consensus will do in that space. So there is a lack of industry consensus on how to properly define ESG investing terms and rating methodologies, and I think it's worthwhile looking at some of the basic definitions. Responsible investing, also known as ethical investing or sustainable investing, is a holistic approach to investing where environmental, social, and corporate governance, ESG, and ethical issues are considered alongside financial performance when making investments. Under this umbrella, there are a number of different investment approaches, including impact investing. Impact investing is investing with the intention to generate positive, measurable social and environmental impact alongside creating a financial return and what we would hope would be a positive financial return. So I guess impact investing, if you just look to this slide, the impact intention, which I find quite interesting, from traditional investment, which is kind of agnostic in what impact it's making other than financial return. Then you've got kind of your avoids harm. So there are a lot of investments in the space of positive or negative screening. So they're not actually trying to make a difference in the world, but they do so by screening out negative things or only positioning their investments in a certain light. And then there's the other end, which is more the impact investing side, which is what benefits is that doing for the world, and you know, whether it be environment or social, as you know we've just covered, but those kind of what projects and things are they impacting, and will they make a positive impact in the environment, right up until the other end of the scale, which is philanthropy, which is really investment agnostic as opposed to impact agnostic. So I find that an interesting and also quite a good visual, if you can see it, of all of those terms and how it kind of falls under the investment space. So in general, I think I certainly have, and I think, you know, a lot of the investment world is seeing a significant shift in investor preference for ethical or responsible investing. Globally, momentum is building to better align finance with the world's sustainable development needs. So far, the outbreak of COVID-19 hasn't stopped the growth of ESG investing. In fact, it's seen a steady increase in inflows and better than average returns since the start of the pandemic. I think the industry appears to be using the pandemic as a bit of a test as to, you know, will these kind of investments stand up to the traditional investments? Research suggests there's a correlation between sustainability and traditional factors such as quality and low volatility, so which in themselves indicates resilience. As a result, we would expect sustainable companies to be more resilient during downturns. And in this current crisis, with its transformative and devastating impact on daily life, companies with a record of good customer relations or robust corporate culture are demonstrating resilient financial performance. There has been, I mean, just a quick stat, like there's 94% of a globally representative selection of sustainable indices have outperformed their benchmarks. So we are getting some positive data. There has been some backlash in the fact that at this same time, there ended up being a oil war, price war, so that, you know, eliminated most of the oil stocks out of the general index, which most sustainability indexes and things don't have in their indexes because they don't want to support fossil fuels and oil and all that kind of stuff. But I think on the most part, even without that, they have still held up based on these kind of measures of transparency and things within their businesses. So there's certainly an argument to suggest the pandemic may even advance the strategic case for impact investing. COVID-19 has delivered unusual environmental benefits, cleaner air, lower carbon emissions, a respite for wildlife. And now the big question is whether we can capitalize on this moment. I think there are reasons to be positive about this viewpoint. Mainly sustainability and environmental issues are no longer a fad, but are now at the forefront of most conversations. So I guess with this slide, I mean, kind of all different stakeholders are taking into account sustainability and environmental impact. So providers of capital are focusing on, you know, lots of people are putting lots more money into sustainable investments. Employees are choosing jobs because they want to make an impact, and particularly millennials and these future generations, which is a great sign of things to come. I think people have really been drawn, their attention has been drawn to the fact that there has been just so many natural disasters. I mean, just before COVID-19, Australia saw the worst bushfires in however long, and, you know, I don't know, I didn't turn on the TV once and didn't hear the word climate impact or climate change, and whether you believe it or not, that's the topic of conversation. So that's got to be a positive as well. I think, you know, shifting expectations, consumers want different things. I mean, we've now got, you know, people are trying to push back against plastics, people are taking their bags to the shops, just all these things that you wouldn't have seen maybe 10 years ago have, you know, and I know we probably need to do a lot more, but these are things that just to show the shift in our expectations and demands of where we're at. And even the governments around the world, I mean, they're a bit mixed matched, obviously, but and some will do more than others, but it is still at a topic of conversation, whereas it might not have been at all 20 years ago. Battery electric vehicles are no longer a niche industry. I think there's also a wider availability for financial products that direct capital towards a sustainable recovery or green development. And I mean, one of the most important points is that the economics are now adding up. So whether you believe in climate change or not, which I'm assuming this group certainly does, the economics is making it too much of a case to ignore anyway. So almost every source of green energy can now compete on cost with oil, coal and gas-fired power plants. Renewable power is a cheaper option than building new coal plants in all large markets, including Australia. And it is expected to cost less than electricity from existing coal plants by 2030 at the latest. So, I mean, it's certainly heading that way, whether we like it or not. And, we've seen even political and big corporations shifting. BlackRock, like one of the biggest investment firms in the world, moving away from investments in fossil fuels. I mean, that's a huge statement to make. And then they came out and said that actually, not only is it because we're trying to take a stand on climate change, it's because it's more economic and we think we'll do better from that play. And then bringing it back to COVID, I think it's the COVID-19 business reevaluation. The global response to the crisis is unprecedented. 6 months ago, we wouldn't have thought it possible for a government mandated social lockdown, and the scale and speed of behavioural change highlights what can be achieved when society pulls together to address what is a clear threat. And I mean, surely we can do that for other threats as well, such as climate change. So I'm feeling positive that this will be a better moment for people to reassess where they're at. And I guess definitely a broader perspective can help investors and companies identify, evaluate, and potentially mitigate a wider spectrum of risks, as well as capitalize on more opportunities. And this is not just environmental, but also the social side of things and the governance side of things. Companies' treatment of their customers, employees, and suppliers is under greater scrutiny than ever before because of COVID-19. Beyond government pressure to protect jobs, close attention is being paid to how companies treat their staff. And it's reasonable to expect that companies that attract positive recognition will see greater loyalty from their staff, and be more able to attract new recruits after the crisis. Conversely, staff may leave employers that they felt abandoned them when they can afford it. I don't see people leaving until they've got a better course of action, but workers may be less inclined to trade off flexibility for security and be looking for employers that offer good non-statutory benefits rather than just for the highest salary. And every employee is also a consumer. So we could also see market share shift to companies that are deemed to have done their bit during the crisis. Companies that have good relationships and visibility in their supplier base will be more able to manage their working capital and minimize disruptions to production. Even more broadly, we've seen the public and private sector join forces to protect their communities, with governments relying on companies to enforce guidelines on stockpiling and social distancing, like how many toilet paper rolls you can have or how many cans of tomatoes you can buy in the supermarket, and the stickers you see in the stores. And then in return, governments and regulators are providing relief to the private sector by subsidizing wages and adding tax relief. So we're seeing a bit of a coming together of those two sectors. So that to me suggests that there is certainly a positive reaction, and that maybe we could do a lot more going forward, and that COVID-19 has certainly given us a moment to pause and reassess and reevaluate what is important and what we can do and how we can change our businesses and so on and so forth. Guys, I'm just, before I move on, any questions, you know, feel free to interrupt me at any time. I probably should have said that at the start, but you know, love to open up the discussion a little bit more, hear if, you know, hear what you think or have to say in this area as well. Oh.
Thank you, Amy. That was a great start to the presentation. I agree. Please feel free to unmute yourself. We're a small group here, so if you've got specific questions, jump in.
Hi, can I ask a question?
Please go.
I gather you can hear me then. Hi, Jackson's my name. Thanks, Amy, for a great overview. Sorry, I arrived a bit late. Just had a question about, you know, sort of the people power side of things, of you know, the biggest ability to deliver some sort of impact investing at a citizen level is using our superannuation funds. Now, obviously, the COVID situation and the, you know, the volatility in the share markets probably had people thinking twice about where their money is invested in their super fund. So I just wanted to know if you had any thoughts on how this, you know, how the silver lining from the COVID situation that might lead to more people choosing to invest their super in a, you know, for sustainable outcomes. Yeah, I mean, I've tried to do it myself with my super fund, and they don't actually have any good options. I think they're called their social responsible fund. It's, you know, it invests in equities like oil companies, BHP, Rio Tinto, Caltex, Viva, Oil Search, Woodside, you name it. Like all these companies under socially responsible, which I find quite surprising. Yet, you know, you look at, say, the index that John O'Brien came up with when he was at Australian Clean Tech, where he, you know, echoing your comments, how they outperform all the other funds as an index. So yeah, just can hear your thoughts about how we might see a bit more, you know, civilian or citizen level actions in terms of switching their super.
Yeah, well, I mean, I'm hoping that most people won't take out a lot of their money from super with the current government rules. But aside from that, I mean, I've certainly seen a shift in, you know, clients coming to me and saying, I really want to invest sustainably with my superannuation, and how do I do that? And it is difficult, at least, you know, I mean, at the very least, at least there are now some super funds that are purely ethical super funds that are coming, you know, to play with reasonable fees that couldn't compete, you know, years ago because of the fee structure. But there are certainly different ways to invest your super. So I know that most, you know, industry super funds will just have kind of your very broad balanced growth. They might have a socially sustainable one, just like you said, but you know, how do you know what that's actually investing in as well? And that might just be that the company had an ESG mantra, which most companies do now, and whether that's actually making any difference or what you believe in, or even your goals, is a whole nother story. But apart from that, there are other ways to invest your super. So, I mean, there are what we call wrap accounts, where, you know, you have the power to invest in most things. I mean, obviously there is the self-managed super fund side of things, but that can be very technical and probably not recommended for most people unless they have a lot of money, and it becomes kind of a cost neutral or cost benefit in that sense. But there is certainly a spectrum of super fund options in the middle, which most people probably don't really know about, because you kind of get chucked in a super fund when you start work, and then you either leave it there or you know, and some people end up with 3 or 4 money everywhere, not really knowing what it's invested in. yeah, so I mean, I guess back to your question of what you can do is you could pick, you'd have to look at different super funds, see exactly what they were and how they aligned with your goals. Try and get as much information on it as you can. I think usually they have to show you their underlying assets. Some don't, I guess, but you know, I think you could specifically ask what they're invested in or some of the things they're invested in, and or come and see someone like me who can set one up specifically for you. So you know, it's kind of a similar process, but you get to invest in anything. So you can invest in listed shares, you can invest in managed funds, you can invest in you know, just all sorts of things that you might not be able to get at directly without that kind of administration structure. But it gives you the power of flexibility and so many different investment options. So does that?
Yeah, that's great. Curious to hear a bit more about wrap accounts, and I have to apologise. I've got to shoot to another call at 1 o'clock. Sorry.
No, that's all right. Well, so a wrap account is purely just the administration structure. You can have one for just in an investment account, but you can also have one for superannuation accounts. So they are a little bit more expensive in administration fees, but often not. And depending on how much money you have in superannuation is kind of where you level that out. And also, do you think you can make that up by the returns that you're going to generate by what you're investing in? So they are purely the administration structure. You pay a fee to whatever company. I mean, like, you know, BT Wrap have one, there's a Net Wealth, there's Macquarie Wrap, that, you know, all the big kind of players have them. And then from there, you invest in an array of different investments. So then you can have the option to have a managed funds, direct listed shares, Australian shares, international shares, you know, really anything except direct property or unlisted assets are the scope of that. So it really opens up the options for you in that space.
Oh, that's really interesting. I hadn't heard of that before. Thank you.
Yeah, it's okay.
Thank you, Amy. We've got a couple of more questions. Do you want to take them now or keep them for the end? Yeah?
Space was just really about investments, and I was kind of going to run through the difference between, you know, defensive to growth and then passive versus active investing, but maybe we could cover that with some of these questions. So
yeah, that works well. Perhaps I've got just one more question to close off the super topic. So we've got one of our members who asks, I'm thinking of changing super funds based on ESG performance. What's a good measure for comparison / performance in these volatile times? Is now a bad time to be changing super funds, is the question.
Now is not really a bad time to change super funds. I mean, you would think that kind of, you don't want to sell low and buy high, but if you're kind of selling low and buying low, you're kind of a net position in that sense. So I mean, there's not a huge disadvantage to in changing super funds because the share market's taken a bit of a tumble, because you would think that you would get in at lower prices on the other side as well. So you know, what happens in that week or few days that it takes to roll over there is really neither here nor there, unless the market, you know, goes nuts in the day. But so no, I don't think it's a particularly bad time to change super funds. In terms of what's a good measure of performance, you know, you'll see that most any investments that have been invested in the equity markets have all been significantly hit. So there probably wouldn't been much of a performance in the last year, if not negative. So, but what I find with a lot of the large super funds, like the big industry funds, is they do hold up pretty well, because a lot of them are invested in a lot of unlisted big infrastructure assets, or, you know, things that they can price not daily or market daily. So it's kind of priced however they really want it to. And that holds up their performance pretty well. So I think, you know, most averages are between, you know, 6 and 8% a year for forever. But that's probably not the case this year. That'll probably be their like 10-year performance. So I don't know, I guess it really depends. And I also haven't seen a huge difference in performance between the kind of socially responsible super funds as well. So I guess it's really depends on exactly what you want to invest in and how well you think it will go, and you know, whether you want to be specific like I've just mentioned with the wrap accounts, because then you can really hone in on different aspects, or you just again putting it in another general kind of source where you know, you'd have to find out what they were investing in and whether you thought that would do better. But I would assume that they would both hold up pretty well, and that you probably wouldn't be doing yourself a major disadvantage, and you would be aligning your investing with your, you know, ethics and interests.
Thank you, Amy. Great response. There are more questions, but I suggest that you go through the end of your presentation, and we'll keep 15 to 10 minutes at the end to go through the questions.
All right, well, I might ask again in another 5, but I'll just go through this quickly.
Sounds good.
So I guess just wanting to talk a little bit about how investments work. So there are a range of different asset classes, and then within each of these asset classes, there will be lots of different options for impact and sustainable and ethical investments, which are now coming to light. So I guess on the defensive side of things, there's, you know, just your basic cash and savings accounts and term deposits. So within that, there is absolutely no risk of losing money. I mean, Australia government guarantees your term deposits up to $250,000. So you can spread that across different institutions, and you can reasonably assume that you would never be losing that money. However, interest rates are historically low, and you're basically moving backwards compared to inflation when you leave your money there. However, cash is king, particularly in times like this. So you always want to have some cash. And then as we go up the scale, kind of, you know, we're getting to more risky assets, but then there's also the potential for higher returns. Within the defensive space, there's also what we call bonds, which are kind of either government bonds or corporate bonds. And just to highlight the difference between debt and equity. So debt can often be used, or it is assumed to be a kind of defensive asset class. However, that doesn't mean it doesn't come without its risks. I guess it really depends on what you're funding. So debt, I mean, you can really, companies fund their projects either with debt or equity or a bit of both. And when we say debt, it's as you as an investor are loaning money to this company or the government, and then in return, they give you an income, a regular income. And then you would expect to receive your payment that you lent to them in full at the end of that term, whatever the term is. That's kind of it as a basic theory, but there are loads of different types, and there's ones listed on the exchange which change in price daily, and there's floating notes, and there's all sorts of different corporations. But within that space, they've seen a lot of, in the impact investing side, a lot of what we call green bonds. So, you know, green bonds are designated bonds to encourage sustainability and to support climate change and climate related projects. So people will lend money to those specific projects to do good in the world. And then when we get up, so that's kind of the defensive end. I don't, you know, I could talk for hours on this kind of stuff, but in the interest of time, let's just move up to, so then we can kind of get into the equity, which is your Australian shares, international shares. You can have listed property stocks as well, or you can have, you know, just Australian real estate, which is your houses, but it can also be commercial real estate. All have a lot more risk involved with how they're priced, but there is potential for much larger reward. And then at the very end of the scale, there's kind of the alternative investments, private equity, which is things that are not listed on any markets. They could be very, I mean, probably Camille has a lot more information on a lot of these investments that would be in this space. So could be kind of funding for certain projects, just like with the debt stuff. You could do it with a company that's completely unlisted, and there might be, there's often kind of tax incentives for renewable or agriculture or kind of projects within the world, so, or in Australia even. So I kind of guess that's like the broad ranging investments. And then within all of these asset classes, there is, you know, certain stocks like you can, so in the Australian equity side, you've got things like New Energy Solar. You can invest in Australian Ethical Investment Limited. You can invest in the actual company of that. You know, there's just a range of things. And then there's also like managed funds, which, yeah, so I don't know. So here's where I wanted to say, should we ask questions, or should I go into a bit more about passive and active investing, what that kind of looks like? ETFs, I know, are a big, you know, big buzzword at the moment, and particularly within this space, there are a lot of different areas to invest in that side of things. So
Amy, thank you for that great slideshow with the full spectrum. Actually, there was a question on bonds, so I might ask it now. So Robert asks what your views are on the impacts to future bond markets, particularly with the current 0/negative interest rates. What are your thoughts on the bond market?
Yeah. Well, it's hard. I mean, the general consensus here in Australia is that we probably won't, our interest rates won't go any lower. They might, but you know, nobody really wants to see a 0 or negative interest rate environment. And that's not the political landscape I've been hearing either. So the bond markets have actually done really well with lowering interest rates. So usually it's kind of an inverse relationship between interest rates and returns you can get off bonds. So I don't feel like there is a lot more in this space at the moment. However, there are a lot of corporations definitely trying to price in. So, you know, there will always be risk return kind of trade-offs, so that, you know, where there's a company that might be deemed more risky, then you would certainly be able to get a higher return from that, because they would be offering a higher interest rate. So there are definitely places for this that you could still earn money, but I don't think it's going to be the money maker. And I think particularly in this current climate, growth is where you want to be if you can afford to. So as long as you know the risks, you know that it's a long-term kind of perspective, you're happy with short-term volatility, I think there'll be far more opportunities in the growth space of the equity side of things than the bond market, purely because we've seen a massive crash in the markets. We'll probably see more. And I think opportunities have already started to show themselves in different areas. And I think, yeah, from the bond side of things, I don't think there is a lot of return potential in that. I mean, you might, but I guess it depends on its place in your portfolio. So if you just want it to outperform cash and term deposits a little bit, that's where, you know, I kind of put it into a portfolio, because they can, and then you kind of play with the credit rating of each different corporation and government and things like that to get the return you're kind of seeking. But certainly they aren't without risk, and you'll find that a lot of those corporate bonds, like that are from the NAB or the big banks, you know, any of those kind of big players, I guess there was Qantas bonds too, they would have all had taken a massive hit with the share market fall as well. So that doesn't leave them, you know, they're not safe in that respect. Whereas a bit more of a government AAA rated bond, which is not giving you much more than a term deposit, is more safe in that sense. So yeah, I guess I don't see a lot of return coming out of bonds in the next couple of years.
Sorry, Amy, it's Mike Gear, and I'm actually calling in from San Francisco, which is why I get to have a point while the rest of you are having coffee right now. But in any case, it's a great presentation. I want to thank you for it. And one thing I'm curious about is you work with a wealth management firm. Are you seeing a lot of money move into private equity, or is it primarily into these other asset classes?
Well, I mean, most of our clients are kind of, you know, mums and dads, self-managed super funds, quite wealthy, have, you know, things like that. But I'm seeing, yeah, we're definitely seeing people, we're trying to now encourage people to take a bit more risk at this point in time. We've been kind of de-risking people's portfolios for a few years now. Not because we saw COVID-19 coming, but because equity markets were very highly priced, and we'd had a very big run for the last 10 years, really. So, you know, everyone, I think, in the industry was feeling pretty nervous even leading up to this, and yeah, it's almost kind of a relief. Like, oh, we should now we kind of will see some opportunities that we think will be worthwhile. And private equity, I think, is just such a large scope. I certainly like to have a bit of it in my portfolios, but it's got to be quality. You certainly want to know what you're investing in. It's like, you know, it can be very risky, but it can also, it really depends on the underlying asset. So I do think, though, that is becoming more of a concern for people, because it, you know, it tends not to be as volatile as listed markets. So I think it certainly has its place. And I think, you know, in terms of putting a portfolio together, it really is just searching for what, you know, looking at exactly what you want to get out of it, and then putting together a diversified portfolio using most of these asset classes, but in the way that will make, you know, align with your interests and your ethics and your values, and to get kind of the financial return that you're looking for without you know, doing what you can without taking on more than is necessary kind of risk.
Thanks very much.
So are there any other questions, Camille, or should I, where are we at?
Yes, I think there's just one last question that was shared in the chat. So we've got a question from Chad, who says, given the comparison with COVID and the pushback to reopen, what are the main takeaways you can see for us to tackle the climate change denial movement? Chat, feel free to unmute yourself if you want to ask the question.
Can you say that one more time?
Let's see. Go for it, Chad.
All right, I'll just jump in. Basically, you gave a good comparison between the COVID, like the anti-COVID movement to reopen businesses and people who are denying the fact that the virus exists. I think there's a comparison with them and with climate deniers, because there's obviously, we've demonstrated the ability to shift quickly to close down businesses and close down aspects of the economy to limit the spread of this virus. Right? Yeah. So we've had massive buy-in with that, but there's still people who are thinking it's a conspiracy and pushing against that. How do we take some learning points out of what has been effective with the coronavirus and the COVID response in a positive aspect to put that into the climate change arena? So how do we, you know, bring more people on board? How do we make them understand that it's a bigger, better thing? And what kind of learnings can we take away from the current environment?
Yeah, that's a great question. I mean, I don't know, but I think, you know, I think from what I said, there is reason to be positive because of what we've seen. And I think that, you know, it's certainly more talked about. And I guess what we need, and I think this is what my view is, that even if governments don't do anything about anything to do with climate change, the individuals and corporations are now becoming so involved in this topic that they will be the push to get this across the line. And then ultimately, I think that will then be, you know, cause for voting, or, you know, so then it will push over into the government side of things. But I mean, I guess somebody, we, or, you know, everybody needs to harness the energy that we've just put into doing absolutely nothing and try, well, you know, in this current climate of COVID-19, of, you know, locking down, really taking it seriously. And I think it's because of that kind of overarching and overwhelming threat to our population that people have seen, that kind of gives merit to that. And hopefully we can kind of push that into the climate space as well. But I would say probably Camille is better equipped to answer this question than me. Yeah.
No, it's perfect. That's fine. It's a difficult space, right? It's how do we generate more grassroots movement to get more people on board?
Yeah, and I guess more of this, more education, yeah, just more of it. But and hopefully we can get people listening. And I guess to my point, you know, with climate change deniers and things like that, that it soon is becoming, well, it already is more economical, you know, to use these different renewable energies. So I think it's becoming more not about whether you believe in it or not, but actually this is the way of the future. And I think if we see, you know, more investments heading that way, which we certainly are, more people investing in that space, companies actually taking that on board, because that will be the way of their returns. I mean, that's huge. That's not just, you know, some people protesting about climate change. That's the whole economy is moving towards this different space. Oh, I can't hear you.
No, I'm that's perfect. Thank you so much.
Okay. I think, are there any other questions? I can't hear you, Camille. Yeah.
I was just saying no more questions in the chat that I can see, so feel free to finish off the presentation.
Okay, well, yeah, I was just going to just talk a little bit about the difference between passive and active investing. So, and again, feel free to ask any questions or pop in with anything that you think in this space. But active investing is, active investment attempts to beat a specific market or index. So through investment management or superior stock picking, like trying to actually pick the exact stocks that you think will do, you know, generate the best return. And then in that space, you know, you've got these managers with their expertise, and so they get paid a management fee for it. So it's a little bit more expensive in management fees, but if they can achieve a better result than an index after fees, then you know they've done their job, and that's probably a good thing. That's, you know, what you want them for. Now there is a million of different active investments that haven't beaten their certain benchmarks, and you know they're the ones that you would probably think twice about. And then passive investing is essentially means that the manager's not trying to attempt to beat any particular market index. And when I say index, you know, there's like our index is the Australian Stock Exchange Index, could be the top 200 shares, top 300 shares. There's the S&P 500, which we saw on the slide at the beginning, which is mainly the top, you know, a few hundred of the US shares. There's a NASDAQ, there's indexes everywhere. So, and then there's made up indexes. So there'll be like sustainable indexes, which they've made by negatively screening different investments, which people don't want in that space. Or there's global healthcare index. Anyway, so there's just a myriad of indexes that you can follow. And they are simply giving you exposure to that specific risk premium. And I guess the advantages of those is that the investment fees are very low. It's pretty much just kind of a computer generated system that follows that index. The returns are very much consistent with that index. So you're not really trying to beat it, but you're also not going to underperform substantially. But yeah, but I guess the negative is that there is no chance to outperform hugely. So I like to, I think that both are relevant, and I like to have people invest in both active and passive investments. And then on top of that, ETFs, exchange traded funds, are usually, well, they're actually massive at the moment. I find questions from them all over the place. And I use them a lot as well. But basically, they are giving you easy access listed on the Australian Stock Exchange to a particular index. So if you see there, the IOZ on that slide is the top 200 ASX, Aussie shares. So you basically get the index in one stock. So it's a very easy way to get a lot of diversification into your portfolio for really cheap fees. So yeah, I mean, and I guess in terms of impact investing, there are so many different versions as well. So there's lots of active managers, but I'm finding that within this space, there are quite a lot of ETFs. I think because of the accessibility of it. So a lot of these managed funds, you might need a bigger buy-in. You might need 50 grand to start to invest in. But actually back to the wrap account discussion, that can often give you the opportunity to invest in wholesale funds, but with smaller amounts of money. So that's another advantage of that kind of platform, where you can get access to these wholesale funds, but with, small amounts of money. So it can be something you can invest in through your superannuation and investment portfolio in that sense. Yeah, so I mean, I guess that's kind of the overview of what there is to invest in. I mean, within that, there is just so much more, but I don't want to, it gets a bit off topic when you just start yabbering on about that. So,
it's a great overview, Amy. And if I may jump in, there is a question from the audience regarding your previous slide on active versus passive investing. So the question is there an argument that active investment does not really outperform passive investment results given the premium paid? What are you seeing in the market?
There is definitely an argument to suggest that, but there are certainly plenty of really good active managers as well that have consistently outperformed their benchmarks. And again, I think it really depends on what you're trying to achieve in your portfolio. So as I said, I often have a combination of both active and passive, because you might find that it's just another diversification play as well. So you might find that when the index fell 35% in March, and that wasn't great for someone just holding the index, that an active manager who concentrates, like one of their management styles, or one of their actual, I guess, investment strategies within that fund would be to monitor the downside or protect on the downside. So they might have fallen, even only half as much as the market. So you've saved some performance there. So, I mean, it really just depends on what the manager's trying to achieve, whether they've consistently achieved it. So, that's kind of what we do, is we're always monitoring, we're always looking, we're always researching, we're talking to these managers, we're, looking for the best investment opportunities in that space. But absolutely, there are plenty of terrible active managers, and there has been terrible underperformance in that space from a lot of them, but that's, you know, that's the kind of areas you want to stay away from in active management. Yeah.
So, sorry, a quick question here. Maybe a two-part question, really. One is, you know, what percentage of the investors who you work with are interested in impact investment, you know, the far end of your spectrum there? And then maybe the other question is, you know, post-COVID, do you see any changes in terms of the types of investments that they want to make? I mean, healthcare is an obvious one that people would be thinking about, but I'm thinking about, you know, regional, local versus global. I'm thinking about other types of, you know, issues that they're looking at outside of healthcare. That's an assumption I'm making, so feel free to clear.
Currently, I mean, I probably think about, we have a lot of, it's interesting, there's a lot of interest in the ethical, sustainable side of things from the younger population. So I've found that most of my younger clients coming to me are much more inclined to really want an impact kind of portfolio. And that's what they're there for. Like that's, you know, one of their main reasons is to do that while generating performance, but also to have that kind of flexibility of what you actually can invest in, and to even learn what investments there are available in that space. However, I am seeing a definite shift. Like probably 10 years ago, I wouldn't have heard anyone say the word they wanted anything to do with impact investing. But now, I'm, you know, a lot of the older generation as well has come in and said, no, I think, you know, I want to, you know, this is something that's important to me. What have you got in this space? And also we're trying to start, actually, we're starting the discussions as well, which makes people think, oh, actually, yeah, that would be great. And then we've also got a client, interestingly, who has quite a bit of money, and she just said to us, with this amount of money, I want to invest in this space. I don't care how it goes. I don't care about the performance of this. I want to put it into these areas of investments. So like renewables, water, solar, you know, all that kind of stuff. And anyway, it turns out that portfolio has done exceptionally well. So she's won out on that side of things. But yeah, I mean, it's definitely becoming more of a conversation. I don't know specifically what percentage, but it's certainly becoming more and more common. And yeah, so, and I guess in terms of what is coming, what we'll see, what they want out of this, I'm not, you know, we're still in it. We're still all kind of in lockdown, not really knowing what's going to happen. But we obviously are talking to a lot of the clients at the moment and seeing a lot of investment opportunities. Interestingly, the healthcare and like a lot of our technology investments didn't move so much. You know, they held up pretty well, which kind of goes to the argument of these things holding up a bit better. But we also kind of got lucky as Australian investors with a lot of the US side of things because of our dollar has been so terrible, which has kind of been a bit of a hedge for the underperformance of some of the funds. But I don't know what we'll see come out of it. I think, yeah, you're right to assume that healthcare is something. But I guess we've always we have been thinking in that space a bit, just kind of, you know, because of the older generation, the aging population, you know, yeah, I guess this COVID has just really brought that to the forefront. I think what we might see is a lot more, maybe a lot more in the technology space. Maybe people rethinking how, you know, we can work from home and we can do things. Yeah, I don't know. There might be a little bit more innovation in that space as well that might change what's available and what people want.
Thank you, Amy. Great answers. I'm just conscious of time. We're going to have to wrap up soon. Were there final thoughts that you wanted to share with us from your presentation? Or?
No, I think I'm probably wrapped it up. If you have any other questions, happy to ask them.
So I won't take any more questions, but you are all welcome to email them to me, and I will be sharing Amy's details with you all if you want to further chat about your personal finances, or if you have other questions. Yes, Amy, if you want to perhaps stay on your last slide with your contact details so that everyone can...
My last kind of slide, I didn't really get to that, but my last slide, I guess, was just really defining, you know, what are your values, what you do want to invest in, what is important that you make an impact in, and then kind of evaluating what's out there, what is the options to invest in, how you can do that, and then work on how that's going to happen. And that's kind of the overarching theme of how you want to make these, you know, an investment portfolio or a super portfolio or whatever it is, with this impact investing in mind. So I guess that really sums up kind of bringing it all together. And yeah, I mean, it's going to be certainly an interesting journey and an interesting time now to see what does come out of COVID, and whether, you know, our views are correct, or if they're not, or if but it's definitely a time, isn't it?
Thank you so much, Amy. Wow, great presentation, lots of insights and things to think about. Some great personal finance advice, but also a lot of context to what we're going through with COVID. So thank you so much for a great presentation. Again, if you want to get in touch with Amy, please do not hesitate. The contact details are on the slide as I speak. I might just finish off by saying that I really enjoyed this session and the interaction. So I really hope to see you again at our coming events. So I'll just quickly share what those are with you. On the 2nd of June, we will be talking impact investing with the Impact Group. So we'll go through Australian trends and global trends. It will be a good one. On the 16th of June, we will be talking about connecting finance and natural capital with Piacha Kearney from Forever Wild. That should be an interesting conversation for everyone interested in sustainability and how we can use our investment for conservation efforts. And finally, just confirmed today, on the 23rd of June, we'll have a conversation about superannuation with the co-founder of Future Super. So do not miss this one, it will be a good one. If you have any feedback on those events, please reach out. I want to make this group great. I want to grow this group and its impact. So share with me what you thought and how we can make it better. Meanwhile, just Amy, note that, you know, there's lots of thank yous in the chat. So I think everyone enjoyed the
thank you for all the questions. It makes it better when it's a bit more into it.
Yes. Amy, thank you again. I think that's it for today. Thank you so much for your time. And I will chat to you soon.
Thanks, Camille.
Bye, everyone. Thank you so much.